Hey guys, how's it going? Value Venture Investing here. So today we're going to do a video on why 99% of investors lose money. And this is actually a fact, like a ton of investors lose money. I thought this was a good time to do a video on this because we've seen a lot of these macroeconomic trends, and these kind of trends that we've seen in the economy and the stock market magnify these. They magnify all these reasons that I'm going to be talking to you guys about. So I wanted to outline some of them. They're very interesting. A lot of them have to do with behavioral finance. And I wanted at the end of this video to give you guys some strategies to avoid these. So this is something very important to take advantage or to take to heart right now, because these are the times that you can make bad mistakes. And no matter who you are, you're still susceptible to these things in the market, right? So as I've said to you guys before, the best strategy, and if you haven't heard this from my channel before, the best strategy for any investor, even if you're a sophisticated investor, studies show, and I tend to agree, is just to buy an exchange traded fund or an index fund that tracks the market. You could buy one for the S&P 500, the Dow Jones. I wouldn't recommend it so much in Canada because I particularly don't like the stock market that much, except for certain ones that I'm picking. It hasn't been doing that well for a while. But if you look in the States, we have long periods of time that we can look back. And the best thing that you can do is just buy an index fund or an ETF that tracks the market. You'll get on average about 10% a year. But most people don't, right? So like I said, there's many studies of this. Let's look at one study right now. So this is the Dalbar study, just one of many. So this was 30 years. So this is the 30 years of the average equity fund. So that's, stocks versus indexes. So if you look at this here, we're looking at the top line here. The average investor, this is pretty pathetic, made 3.98% per year between this period of time. It was 1987 and 2016. If you look at, then also before we go, that we have the 1 year treasury as well. Then if you look at the S&P 500, like I said, is about 10% for that same time period. And if you look at global equity, an index there, I'm not sure exactly what they're referring to there. I think it's more of a global index. It was even slightly more there. So you can see that, the return for investors over long periods of time has been garbage. That's not very good. That's like what the housing market, like I live in Canada here, that's like what the housing market returns a year, about 2-3%. The Bank of Canada just came out and said they expect housing is going to be continuing at about 2% a year. So it's around 3% a year. Stocks should always, long-term index investing should be much more than that. So why these investors lose this money? Like, why are they losing that percentage? Well, the biggest reason is they trade way too much. And with trading comes all these other issues, right? So I wanted to talk about these one at a time. So the first section is emotions. So this comes into behavioral finance. If you haven't studied this, look into this. If you're an investor, you have to be aware of these. I even am susceptible to these, and I've studied these quite a bit. I studied this quite a bit in university. So the first one, I've done a couple here that I think, there's a ton of them, right? But these are the ones that I think are kind of probably the most prevalent, the ones that really hurt investors the most. And one here, for example, is one that doesn't really get a lot of attention. So the first one I was just going to mention is gambler's fallacy. Now, quite often this one isn't associated with stock markets, but it really is if you think about it. So the gambler's fallacy is essentially related to gambling because of the name. So let's use the example of you're going to the casino. So say you're playing a game of blackjack. Your odds are something like 48%. I don't know the exact odds offhand here, but it's about 48%. Now you could lose, at 48% odds, you could lose 10 times in a row. Technically, statistically speaking, you could lose 100 times in a row. But what happens is if these, not investors in this case, gamblers, say you lose 10 times in a row, and you see it all the time. People say, well, I'm due for a win. I have to. I've lost so many times now, I'm due for a win. That's gambler's fallacy. Because the reality of the situation is when you actually know a little bit about statistics, if it's each one of these is a separate event, as we'll say a separate statistical event, you have that 48% opportunity, or the 48% chance to win every time. They're independent trials. So just because you've lost 10 times in a row doesn't change that. So you're not any more likely to win the next hand if you lost 10 than you were before. So that's gambler's fallacy. So this relates to stock markets quite a bit too, because people think, say you took Apple, for example, recently, it was going down, 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 down. Well, you think, well, it must be. I mean, it's gone down like this many times in a row. It must be due to go up. And that's not necessarily the case. You might see a little bit with, investor psychology there. Other people might be thinking the same thing, so it might actually happen. But you see a lot of these types of situations in the stock market where people are kind of using gambler's fallacy, and it's one that doesn't get a lot of attention. Another huge one is confirmation bias. So what this means is that you're basically going to pay attention to information that proves your premise or proves your point, right? So, for example, if we were talking about Bitcoin, we saw Bitcoin skyrocket last year. Now it's just been tanking. And what a lot of people were doing was there's a lot of negative things that you could take into account with Bitcoin. Like Jamie Dimon came out and said some negative things. But most people that were really into Bitcoin didn't pay attention to any of that. All they listened to was the positive news. Like, for example, McAfee came out and he had some positive news, or he'd say something positive. So confirmation bias is just basically taking what you believe to be true, whether it's positive or negative, and only paying attention to that and going, well, that's confirming, so that you're biased, right? That's confirming my thing. If you're a true, objective investor, you should be looking at both and giving both of these as much validity, as much scrutiny, if you will, as just your confirmation, your own bias, right? So that's a big one where people lose money. Another one, this one has actually been huge for me, loss aversion. So what loss aversion is it's essentially saying, say you could make $1,000 or you could lose $1,000. You're saying it's more important not to lose $1,000 than it is to make $1,000, when in fact, they're the same or whatever. And the reason behind that is because investors, it's been statistically shown, like studies have shown, that investors feel 2 to 2.5 times the pain from a loss than they do from a gain. So that's a very powerful emotion. So it actually prevents investors from investing more because they don't want to feel that pain. So they would rather not have that pain of a loss than to have a gain. So I have a really good one for this. I wrote here as well, New Gold and Netflix. So one of my first investments ever was New Gold. I made about $30,000, and that was back in 2009, I believe, yeah. And I sold it, I made the gain, and then I bought back in with, $5,000 or $6,000 or something, and I ended up losing at that point significant amount. And I was down, and I think I was down on a bunch of my other stocks as well, and it was just that bad feeling. I felt bad. And along came Netflix. This is around 2012 I was looking at Netflix. And I recall that I sat down and I did sort of a relative evaluation. I looked at its peers. I looked at, I tried to project it out a multiple. I haven't done a video on this yet for you guys, but I will. I was trying to figure out what kind of money they could make, what kind of multiple. And I thought, man, Netflix is so cheap. And I think they're going to be big with Apple. And at that time, Apple and all the, the Samsung and the Android devices were getting the apps for Netflix. And I thought, this has only become bigger and bigger. So at the time, I put an order in for $10,000 in 2012. So if we take a look here, it was around 2012, like I said here. It was about, I think it was about $9 somewhere here. I saw this dip and I saw this as a very good opportunity to get in. So I put an order in for $10,000 in the market, and it hadn't filled because I wanted it. I think it was at like $35 at the time. Keep in mind the stock is split, so that's why the price is different. If you don't know what a stock split is, I'll put a link right there right now what a stock split is. But it split, so that's why the price is different. So I think it was about $35 a share, split adjusted, that I was looking for, and it hadn't quite reached that level yet. And what happened was I started thinking about the losses that I had with New Gold and with other companies, and I actually ended up canceling, because in my mind I thought, this is a risk and I don't want a risk anymore. I thought, well, maybe this is too much of a risk, and I had the feeling, this is the most stereotypical loss aversion you can have. That's exactly the way that I felt, and I canceled it, and I just sat and I didn't do anything. Well, what would have happened? That if I would have held until the peak here not too long ago, over $400 a share, I would have turned that $10K into almost $450,000, right? I don't know if I would have held the entire time or whatever, but that's sickening. But that's the power of loss aversion, right? It's just a very powerful emotion, and it can really affect investors. So that's my personal story on that one. This one too, not selling gains and chasing losses. I mean, this is also related to what goes up or down must continue. And this is just a psychological thing. People think that good times are always going to continue, and people think that bad times are always going to continue. Just think about bad times in your life. When you had your worst times, you always think, this is the end, this is going to continue, but it always turns around. Just life is like stock markets. Things are cyclical. They're up, they're down, right? So the key is you have to sell when you have gains, right? When you're up 5,000, whatever, you might be up dollars, and you think, well, I want more. As humans, we always want more, right? Those are the times that you should be taking those gains, right? But instead, what happens is we don't sell those gains. We wait until they turn into a loss. Perhaps macroeconomics change, the company itself changes, and we see that, that huge gain or that nice little gain, even if it's a small one, turn into a loss. This is key. Over time, these add up, right? Even if it's a couple $100 here, a couple $100 here, a couple $1,000 here, we see it turn into a loss. And then what people do is they hold those losses and they don't sell them because they think it might go up again or whatever, right? So that is a huge one, because I think that's probably one. I might even circle that. That might be one of the biggest ones why people lose money. And I've been guilty of it a lot myself too. Even if it's a small game, lock it in, right? And another huge one is herd mentality. We see this one all the time. We saw this one in the .com bubble, and we saw this one most recently with Bitcoin. I even got into that Bitcoin one a bit as well. I still haven't changed my opinion that I think, if you watch some of my other videos, that long term it could be something really big, and you should have a little bit of in your portfolio if you could. But like I said in my other videos, it's extremely risky. So you have to assume that money's gone, sort of thing. But what happens is people have the FOMO, the fear of missing out. You see this irrational herd mentality where people are just following what everybody else is doing. They don't want to miss out. Everybody else is in, and you get this herd mentality. So those are some of the biggest ones that I see emotionally wise, and these are all to do with behavioral finance. Another one is just, ignorance, really, not understanding cycles and the macro events. I talk to people all the time about it, and they might say something like, oh, as of lately or last couple of months, they say, oh, the stock market's doing horrible. We're in for a horrible time in the future. It's so much for what you're doing with your investments. So these people, they don't understand that there's market cycles. They don't understand that, interest rates have a different effect on markets. We see inflation, go up, and they try to, clamp down on that with fiscal policy, and these create cycles in the market. And then you see macro events like these, like lately, like the trade deals, all these different types of things, right? So what they don't understand is things, like I said before, don't go up forever, right? People keep thinking what goes up forever is going to keep going up, and what keeps going down is going to keep going down. They don't have the knowledge to understand this. And the ones that do understand it just hold and stick with a long-term strategy. That's why trading and day trading is never usually good, in my opinion. And the last one that I get a lot is get rich quick. That's probably the best way that I can describe that one to you. When people ask me my advice on stocks, sometimes I might give them, the long-term thesis that I have on Apple, why it's such an amazing buy. Or I might say something like, get into a high-yielding dividend stock, because that'll be great over time. You can even double your money. Say use the rule of 72. If you're not aware what that is, look that up. That shows you how quickly you can double your money off a dividend. But people their eyes tend to glaze over when I say that to them. And they want to know what's going to make them a quick buck. What's going to be the next Bitcoin? What's going to be the next, Netflix, how quick Netflix went up? That's all they're interested in. People think that the stock market is like a get-rich scheme. And that's why it kind of gets a bad reputation. Everybody seems to know somebody, oh, I know so-and-so who lost a ton of money, or I know so-and-so who lost a ton. Well, that's because most people treat it like it's a get-rich scheme. And those who do that generally lose money. Like Warren Buffett says, the stock market is probably the best tool out there to take money from the impatient and transfer it to the patient, right? So everybody's concerned with the get-rich quick now. So if this is the case, if we have all of these, emotional biases, ignorance, and, this is emotional as well, how can we combat this? What should you do? So I have a couple pieces of advice I'll give you. I'll erase the board and we'll go over those now. So now that I've went over some of the reasons why people actually lose money, what should you do about it? What should you be aware of to try to prevent these from happening to you? Well, obviously the biggest one that is pretty simple is education and experience. What I mean by that is if you don't know much about behavioral finance, you should be studying it. Like I said before, if you're in the market, study it. And with experience, you'll see these things happen within your own investments. You'll see yourself doing it. And, I don't know, I've been investing for maybe 11 years, something like that, 11, 12 years. And I still see this in myself. So I'm not sure if it's something that you can ever get rid of, but it's something you should always work on and you should always be aware of, right? So if you don't know much about behavioral finance, look that up. This one's the most important as well, in my opinion, other than education. Have a predetermined strategy. So what I mean by that is go into a stock, go into a position and know what you're going to do with it, right? So if you're going to have it as a long-term hold it long-term, and unless there's some material information that comes out that's going to really change your whole thesis on this stock, just hold it. If you're going to trade it for a short period of time, make sure you do what you're going to do, because otherwise those other biases are going to come in. So for example, one that I had here recently was Facebook. I bought a small amount of it. I think I bought something like $5,500 worth of it or something. I just made, it's actually funny, before this video, I'll show a picture of it on the screen right now. It just sold. It just filled at, what is it, 145. So I made somewhere around $250, somewhere like that, US. I'm Canadian, so it's even more money. I mean, was it almost $300 Canadian? And it's not much money, right? But that was my predetermined strategies. I thought I don't necessarily want to be in Facebook long term, but given a lot of different things and some of the stuff I talked about in my other videos, I think I could get a quick little pop out of it. And especially with Apple and some other companies pulling back, I want to have that capital to invest. So that was my strategy. So what I did was I put in a limit sell order and I left it. I didn't even know before I made this video that it had sold, but that was my strategy. I was happy to see that it hit 145, and that was my predetermined strategy. And now I made $250. It's not, a huge amount of money, but you do that enough times, it adds up, guys. You do the opposite and lose money, that adds up too, right? So make sure you have a predetermined strategy. And my last one that I always like to tell you guys, because it's going to be your friend if you have time on your side, is a long-term hold. How do you mitigate these things? The majority of your portfolio, in my opinion, you should have long-term. When you're investing in the economy as a whole. If you can have, say, an exchange-traded fund that tracks the whole market, and you're in it for the long term. I do short-term stuff sometimes, like I just mentioned with the Facebook, but I also am quite experienced with it as well. And it doesn't always work out. I like to have it work out more than it doesn't work out, obviously, right? And it has, so I've made money that way. But the majority of your portfolio, in my opinion, like I said, everybody's different. This other video that I gave you guys recently, do your own research, is long-term hold, and you can avoid all these biases by just sticking to your guns, investing in what's a great undervalued company, and holding it for long periods of time. So I really hope that this was a helpful video for you guys. I thought it was a very good time to put it out, considering all the markets, how they're up and down and all over the place. Let me know down in the comments if you like the video. Please hit a like and subscribe if you can. It really helps my videos become recommended more often, and then I can make more videos for you guys as well. So that's going to be it for today, guys, and I'll see you in the next one.